All right, so we're just going to start the little show now, and then we'll continue this lovely conversation. Okay. Good evening, everyone. Welcome to the Investment Club 2021 with your hosts, Stephen and Melissa, who's back and good as ever. Nah. And just a couple household rules for tonight is all the discussion tonight, it's a discussion format. So you, the audience, as a reminder, are free to jump in, ask questions, and share your thoughts. And a little quick note, just everything we're discussing tonight is really educational purposes only and does not count as investment advice. Now, we know a couple of you are returning, such as Ian. It's great to see you. We got Maggie, Teresa. It's great to see you guys back. And of course, we have Lindsay, which we haven't seen for a while. It's great to have you back. And hopefully you'll learn some new things along the way. And of course, we've got Teresa has always been the rock star helping us out, bringing a little bit of spice to the conversation with good questions when you're on that verge of learning all the time. And of course, none other than David, who is also an expert in a bit of trading and managing risk. So before we begin, I just wanted to announce that, so for this month, or sorry, this presentation, we're going to talk more about US related stocks because most of the times we've been more focused on the Canadian side of things or investments. And we just want to spice it up a little bit, dive a little bit to our southern borders because we know they have a lot of great opportunities, a lot of more, you say, liquid, meaning there's a lot more traders in that market compared to the Canadian side. And just to start off, we just want to go around and see what everyone's been looking at before we jump into a little presentation. So I guess let's start out with David, since you're back after a couple of weeks. So what have you been looking into of late? Go there and share. Okay, and let us know what you've been looking at.
Sure.
Don't worry, folks. David's just getting his account ready, spicing it up with excitement.
One of the ones I've recently been looking at. I picked up. Well, there's actually two of them. One is called Sense Solar, and these are all. I'm just pointing out some of the real small penny ones, so it's easy for people to afford. Ascent Solar Technologies. They do basically. What do they call it? Photovoltaic technology. So basically, you're looking at your help me here. Your
solar
panels. Yeah. Couldn't think of the word solar panel for a minute. Just disappeared. They basically do solar panels. They just got a small contract with NASA. So they're going to be doing some work with them, doing solar panels for satellites.
Oh, do you have the stock symbol by chance?
Yeah, it's ASTI.
ASTI. Oh, Ascent Solar Technologies.
Yeah.
Okay. And we're just going to let this do a little fire up. We're like, yeah, it's definitely on the penny radar. I know Ivan loves that a lot.
Oh, yes. Oh, yeah. I'm just picking ones that are really easy for people to afford, even if they just wanted to jump in for a few dollars.
That makes sense. And a kind little reminder for people, because when you do trading fees, of course, it may cost $10, some of you maybe $5. These tend to be more, if you like to put a little bit more to it, makes it a little more worth it. And you're betting on exponential gains.
Yeah, I mean, what you're looking at here is you're not going to see a lot in this chart that's going to make you want to dive on it. What I've been looking at is what they actually have in the way of you're looking when you're buying stocks like this, you're looking at the future of the company. So basically, this particular company really has a good foundation. They have a good product. The potential is there, but whenever and I always tell people like this, whenever you're buying into penny stocks like this, you're buying into as I said, the future. Don't expect to put in a little bit of money here and have it double by next week. These are things that you're going to buy, you're going to throw in there, and you're going to look at them every little once in a while. And in the next few years, you know, they'll start to blossom.
That's really good. Even just looking it out, I mean, the average volume for this thing that's a lot. 220 million shares get traded like on average every day, even though let's say today it's a little low, but again, maybe somebody's just not feeling it today. Maybe they'll do it next week or tomorrow.
Well, yeah, the yield, unfortunately, I don't know if you guys know about what bond yields are, but basically the bond yields have been taking the tech market over the last 6 weeks and just trashing them.
And I'll add to that what David was mentioning with the bonds is, so what happens is when the price of bonds tend to go down, what happens, the interest rate of those bonds will go up. So for you, if you were buying bonds, let's say if it went from 1% to 5%, you're like, oh, that's amazing. That's great. I can just get 5% risk-free return from the government. But for most individuals who invest in the stock market, who borrow money, that's a bad idea for them, because now, let's say their average, let's say top-up rate the banks may charge, let's say an extra 1% or 2%. So it's now on top of, let's say 5% plus the like added interest rates, of course, to those investment firms. They're not too happy about it. Like, let's say I'm being charged such a high percentage just to make a bet, let's say betting on tech companies, for example, hoping I'll get like rocket returns. And think of it, it's really the cost to borrow money, essentially, is what it's affecting.
Yeah, so basically, as the bond yields go up, the values of the tech stocks especially go down, and people pull money out of the tech stocks to put into the bonds because, like you said, they can get safer money. So they tend to, the techs right now over the last 6 weeks, they were doing well 6 weeks ago. Basically, you could pretty much, you know, throw anything at them and they were making money. And then suddenly the bond yields went up and the whole tech market is just down right now. It's going to come back over the next few months, but you know, but yeah, that's why I like right now, because the tech is down so much. That's why I'm heavily looking into tech right now.
As we're putting it, we're trying to buy the dip.
Yeah, you got it.
And even if it's simply you put a couple thousand on it, or you could say a larger chunk of it, it's really up to you as the individual. It just depends on your flavor of risk, and of course that eye for, you could say, timing. And that's really the biggest factor to make money in the stock market, getting in at the right time. Hey, sometimes even if you're sometimes a little early, like a couple of years, well, at least it's better than being late. And all right, so with that, I'm just going to dive around to our other audiences, see how everyone else is doing. So Teresa, have you been looking into anything of late? Oh, Teresa, you're on mute.
So I was, there's a couple that were sent to me to kind of monitor. They're a little bit higher.
Okay.
There's one that's called Kirkland Lake Gold, and that is KL.
Yep. Oh yeah, that one. Oh, sorry, I'm gonna get the Canadian one.
Yeah, they've been around a long time.
Yeah.
There we go. $42. Yep. And so, what got you interested to monitor this company, by the way?
It was just sent to me, and so I was just kind of looking at its history. It seems to have been around quite a while, and it looks like, yeah, there's some highs, and it's kind of come down a little bit, but it's still up overall. Looks like it still has a little bit of room to kind of go, and it doesn't look like it's going anywhere. And the other one is pretty much it's the Manulife financial. So that was the other one, the Canadian one as well. It's a little lower in price, but
yeah, they're sitting around 26, 27,
Yep.
Yeah, it is down right now, so I'm not sure exactly for the day anyway, but they're kind of slow risers as well. So obviously they're not as new as the ones David are looking at, which I really like as well.
Mm-hmm.
But these ones kind of show if you do get in early, they could be like these ones.
Mm-hmm. If we're even saying, like, let's say you've got this back last year, even just, let's say from the July all the way to October time. So you had a good, lovely couple months to think about it. So no need to rush in. And it was like, oh, I was trading around the, let's say 17 to almost 20, or say $17 to $20 range around. And of course, one of the little bumps we'll notice after November, and it went all the way up. And part of that was a lot of institutions were looking at, okay, there's a great opportunity to buy into these undervalued financial companies. And that's where you see this nice little rise. But then again, Manulife was paying a pretty nice dividend when you're at around that $7 to $18 mark. It was right around, you'd say, right around at least closer to 6% at least. And that was just, if you owned it, it just paid you 6% every year, which was pretty nice. And just to add a little bit on.
It does seem to be trading at the 52-week high.
Yes. Yeah, you're definitely right. It is creeping up back to its old high. I'll pull back the 5-year chart, and you'll notice that was before COVID hit. It was right around that $26, $27. Of course, COVID hit. It got sunk for a while because everyone wasn't certain is when's COVID going to get you could say resolved, when's the vaccine coming. And that's why for that period of time, you'll notice the company was more at a depressed state in terms of price. But that also means there's also great opportunities. If people don't see it, there's opportunity now. That's where you can get in early.
Yeah, they're a good company. They have some innovative products in the financial services industry. Mm-hmm. Specifically, one of probably the best that I've seen is the Manulife One account. Mm-hmm. It's sort of the Smith maneuver all-in-one account. Mm-hmm. Just pointing that out.
I don't see them really being a big up-and-comer. That one I would buy strictly on the idea of grabbing the dividends.
Mm-hmm. Yeah.
Especially
at the 57 mark now. So.
Yeah, I mean, you look at the chart, and they are basically topping off at one of their high points. Mm-hmm. And unless they come up with something just phenomenal, it's not going to boost too much past there. You might go a little bit up, but you're not going to double your money on it or anything. So I think basically you're just looking at it. If you want a nice dividend, I mean, basically we looked at a couple of things before, and if you bought 4 shares of this, it would mm-hmm. basically come out to this roughly about the same price as the Royal Bank, mm-hmm. cost wise, but the dividend mm-hmm. would actually be slightly better.
Oh, that's a very nice little analysis you've done. It's just and I'm guessing that was you debating if you should go with your trusty Royal Bank or Manulife.
I was just looking. Teresa's really wants to, is up on the dividend things, and eventually I'm going to have to look in that direction. Mm-hmm. So yes, I was looking at Royal Bank. I was looking at this one here, mm-hmm. And Royal Bank was running at that time around $107, $109. I don't know what it is right now.
115 today.
115 today. So they've moved a little bit. Yeah, banks are going to move up a little bit now. They're moving into a little stronger area for them in the next little while with mm-hmm. Rising interest rates.
Yeah, there you go. 15.
Yeah. With the potentially rising interest rates, you're going to see them move up a little bit. But their dividend is, what are you looking at there?
3.7. Yeah.
Yeah. So basically you're looking at a little better rate from Manulife.
Mm-hmm. TD on the side there. Can you click on that?
Yeah. Sure. Right. Just right there.
Yeah.
Okay. And right around 82. Yeah.
lower price, about the same dividend.
Yeah. Scotiabank isn't too bad. You know, at least on a cost level.
Mm-hmm.
Yeah.
And we can just pull that out just to quickly peek it. Yeah, they actually pay about a 0.75% around.
And they're at a 4.53 for the dividend.
Mm-hmm.
Yeah. Yep.
So it's a definite consideration just to throw in. You want to say, this is a great little option just to lock in that so-called long-term return rate, hopefully. But it is pretty nice just to start. And since I'm sure you guys have been looking a bit on the Canadian side, we're just going to jump a little bit in dividends and into the US. And this one, I'm sure some of you may know them, and some of you it might be new. This company is called Altria. And I'm just going to ask around the room, just take a guess. What is this company? What do they actually do? I'm just curious on your thoughts, just on the name.
They plant trees.
Yep, just anyone can. You're just free to share your thoughts.
I think Ian said something there.
I was just joking. I said they plant trees.
I'm gonna assume it's a financial or something to do with financials.
Okay,
that would be my guess, just off the name.
Mm-hmm. And how about Teresa?
I'm not sure. It doesn't look like it would be a tech or a health stock. It's kind of looks like it's going down over the last 5 years.
Mm-hmm.
Looks like something that you use every day.
It is. Ian's actually gotten a little hint on the right track on that front, actually. And I'll just see if you guys this is actually a tobacco company.
Oh, I was gonna guess car.
I was thinking yogurt or.
Well, I can see why it's going down.
And so one of the things.
It looks like I'm thinking Astro because I had that one.
So one of the things why there's actually it was just around a YouTube channel. These guys were talking about investments, and they were bringing up saying over the past 100 years or so. So you look back in the early 1900s till today, there's a statistic that's like, okay, what was the most profitable industry for those past 100 years? Most of you would think it's tech because boom, you look at all the Apples, the Facebooks, the Googles, like, man, they've gone really crazy. But actually when they did the numbers and ran it, actually it's tobacco was the best performing sector for the past 100 years. Well, of course it's fair because they got a head start from tech because tech's only been right around, let's say 30, 40 years. Well, Altria as a tobacco company would easily have been more than 100 years old. So a lot of actually retirees buy into tobacco companies because, well, part of it's the dividends they pay, which is nice and pretty decent. And you're looking like, oh, it's about 6%. Now, understand the 6% is in American dollars. So of course, if you convert to Canadian, what the exchange rate now on a conservative side, think of it, you just boost that an extra 20%. So if it was, let's say 6.7, doing a little bit in my head, so add about 1.3 to it, that would get you close to almost like 8% return on a dividend side.
If that's okay.
Yeah, I was like, well, that's pretty good at 8%. Of course, in the US, you do get a little hit on the tax like about a 15% withholding tax generally. So if you minus that out, it with the currency exchange rate, you kind of almost like back to like around that 6.7%, just on a back of the napkin math.
So that was one of the things I was going to point out when you said we were going to talk about U.S. stocks. Mm-hmm. It depends on on where you hold that investment too. I mean, RSP is probably the place you want to keep that dividend stock in because the 15% withholding is not there in that particular account. My understanding, but just something to consider, I think, as well, where it's being held.
Yeah, you're definitely right on that, because even for tax-free accounts, for those you haven't done any US trading, is even the tax-free savings account, you still get the 15% ding because it's not included in the, I believe it's not part of the NAFTA agreement side in terms of for tax purposes, it's exempt and all that, which it's not for TFSAs.
Yeah, that's what my accountant tells me all the time. He tells our account, so my boyfriend in construction, and I'm a business owner too, and he tells us all the time that we have to put it into our RRSPs in order to get like the real deal basically on it. But if we also have some in all of our stocks are either in one or the other, but he said that as soon as we take it out of the TFSA, then that's the problem right there. So our accountant like straight up tells us not to put it into our TFSA, like any of the stocks, because of that ding, like you just said. So
and of course, if you think about it another way, if let's say Ultra for some reason went absolutely crazy and it dropped, let's say at the lowest point it dropped to around 30, let's say you got around $36. If we're gonna pull out our little calculator, I'm just gonna try to, I got a little pen on the bottom of my screen and it's blocking me from grabbing what I need.
I'm not gonna like the number.
Yeah, I was like, oh, it's blocking me from getting that. Just gonna put that over here. Okay, and if we're just gonna do this back of napkin math, so let's say right now it's paying $3.44 a dividend a year, and let's say if we bought this at, let's say $36 US, that's without any conversion. That's you're pretty much close to 9.5%.
Sweet.
Which is like, and so let's say if we did the little tack on, just gonna change that so it's 9.5%. And let's say you got an extra 20% boost, let's say because of the exchange rate right now. I know it's a little more, but I try to be a little more conservative just to dumb down the numbers. So if you get anything more, you go, sweet, it's a bonus. And we'll multiply that 1.2. That's, you're almost getting close to 11.5%. Just to own a tobacco company. And of course, a lot of people still smoke, even through the pandemic. So maybe that's a little, you say, recession-proof stock as a food for thought.
Absolutely mind-blowing.
It's amazing too. If you look, when I was looking on my Google phone, it showed me that every other factor, like the 1 day, 5 day, 1 month, every other one, including the max, is all on the rise. But in the last 5 years, it's been on the down. So,
and so part of the little reason Ultra it going down is it's gone into, it's in disputes with the courts because they bought a stake into Juul, the vaping company, right? And that's what kind of knocked them down. It's like, oh, you got into a legal fight essentially, and you're costing shareholders money. Like, well, I'm not happy with that. and that was part of the reason you'll see it's kind of like gradually declining. At the start, when they bought Juul, there was no problem. Like everything looked smooth. It looked all good until you'd say teenagers started vaping with those devices. And let's say the regulators weren't very happy with that little publicity. And they started
publicity. Popcorn lung, it's been not good news.
Yep. And you're like, oh God, you just dropped all the popcorn. Like, uh-oh, I'm in trouble now.
Is Philip Morris an older company than Ultra?
No, I haven't done as much into that. This was me that had, oh, pardon?
Right beside down below and the people also watching.
Oh, yeah. Maybe, unless somebody might know a bit of a different tobacco company, but there might be a chance that Altria might.
It's definitely a tobacco company, that's for sure.
Yeah, I don't see another one. So this might be then again, it may have bought all the smaller guys and it formed the Altria group. So it's basically saying, well, I am the one. And on another company we're going to look at, and I know David loves to check a little bit on tech. We're going to dive a little bit.
There's one too. There's one too that I really kind of like potential, and again, it's a sit and wait. but it's called Vermilion if you want to check that one out.
Okay, Vermilion or
Vermilion, yep.
Energy or?
It's energy.
Okay, so we'll look. Okay, it's got Toronto one, so we'll pop that one out for everyone to see. Okay, so I'm just looking at the charts at the 5 years. It's gone down, which is awesome. Hopefully, it's nothing too major.
if you look at the 10-year, it really gives you a decent view of where it's been and where it is now. And basically, it only dove in 2020 once COVID hit.
Oh.
So right now, at the rate that it's at now, if it even goes, back up to, $14, you're doubling. You'll double your money on that one. Again, it's an energy, so you have to be patient with it. But I like the company overall.
And essentially, even the risk to reward, given it's so low, is like, well, hey, people might just be missing. There's quite a bit of value you're just leaving on the table.
Yeah, you have to do your due diligence.
Yeah,
that goes without saying.
You're definitely right on that. So it's like, yeah, this one, for those you want to dive in the U.S. and want to take a look at, this is a little one you just want to look at. I mean, given the chart, that looks really attractive. Just saying, well, why not? I mean, even if you just bought a little bit to dabble, hey, let's say you went a little optimistic, it doubled to $20. You're like, oh, okay, that's pretty good. You made a right bet, you made some money, and even then, you're still near the bottom of this company. Because it's like,
since like 2004, it looks like the lowest it's been is $20. So it definitely has the potential to double.
Yeah.
And then that being its starting point, right?
Yeah, you're definitely right on that. Even if you look back, even as far as when it first started back in 96, 97, I mean, if let's say you caught it right near the bottom when it was around that $3 range, you're literally hitting it when it just first came out, which you say that was a couple months ago in October. Yeah, that's a really good looking company. Just before the fundamentals, just on the charts. Of course, the due diligence will play a bigger role telling you why it's not nosedive. And just out of curiosity, David, have you looked into what may have caused it to dive in COVID? Because it's not transporting energy, or?
There was, of course, the issue with the changeover from Trump to Biden and the policies on oil and energy the difference in that they have there. So that's had an effect on it, of course.
Okay, so that's really more of a government.
Right. That's why I said you have to be patient with that one. It's going to take some time for them to work things out there, but the potential for the upside. I mean, the company itself is a solid company for the most part. You have to look at the financials and everything else, but yeah, the potential there, I like. So I mean, I bought some, and I'm basically just sitting and holding long.
Okay. Oh, that's
I was going to say that one of the stocks that Phil had bought was Hive Blockchain Technologies.
Yes, I own Hive as well.
Yes, I was going to say it's probably one of the biggest ones that's being talked about on my list because I have Google Finance, so I constantly get notifications about this one. It's only $4.91, so it's doing pretty good for me. Me and Phil probably have about 2,600 saved up just in our stocks that we have. I have a very long list of stocks that we have. I don't monitor it. I just keep watch over some things, and I tell him to buy them on Wealthsimple because we invest mostly in Canadian ones. Because with Wealthsimple, you don't have to pay a fee if you buy Canadian stocks. But yeah, no, that's definitely the one that's I'm constantly watching. So
the problem with Hive is it's a Ethereum based company. Now Riot of course took off. Riot was down at, when I first bought it, it was $11 a share.
I believe it's, okay, so probably this one in the US dollars, or?
Hang on for a second. Let me just dig it up here.
And
Riot is a Bitcoin-based stock. Basically, they're both farms. That's what they do.
Okay.
And it's basically Riot right now is sitting at 53.27.
Yep. Okay, so we're on the right for the same company.
Yep.
Oh, yeah, it's really taken off. Like, I'm surprised even Hive wouldn't go up, because if Bitcoin goes up, Ethereum generally goes up, and it would make sense both of them would still go up versus in this case, Riot's still going like crazy up while you've got the Hive is like.
There's been more hype around the Bitcoin with Tesla and everything else. And this stock is basically, it's mainly running on news reports and the current balance. I mean, if Bitcoin takes a dive tomorrow, that this thing's gonna,
what's their business? What's their model?
Basically, they're one of the largest Bitcoin mining companies.
Okay.
And what really boosted them up is they did a merger with a small energy company. Energy, of course, is the biggest problem with mining Bitcoin because it takes so much energy to mine. So they partnered up with an energy company to get a reduced rate for energy.
Smart.
So that's what pumped them up.
Ah, that's really good, actually. That's a nice way to lower your cost at a opportunistic time.
Yeah, they've really helped out companies like AMD and who's big Navi?
AMD and NVIDIA?
NVIDIA, right?
Yeah. Oh, bless you. And of course, and on also another one that we've been looking at, and this one most of us may not be on our radar. It's actually the Hilton Worldwide Holdings. So of course, most of you think of the hotel or the hospitality industry is like, what's going on there? And aren't they still in the gutters? Is like, so what happens with Hilton? And I know Melissa's done a little bit of research on this. Melissa, you're still there?
I'm here.
All right, so we'll just let you share the spotlight. Give us a little bit of a rundown about this Hilton. What's making you optimistic about them?
So basically right now with the Hilton, it has been starting, well, it did take a dive, as everybody could probably see, but because now with COVID and it being used for vaccines and one of the government controlled hotels right now, based on some research, Hilton is starting to slowly increase its value. Hilton drastically dropped over in 2020 down from 109, 110 a night to $47 a night. So then when COVID, because COVID, people weren't going there then, so government started backing the Hilton and using it as one of their supporter hotels for people who started to decide to travel. It is back up again. So I'm kind of just looking at the Hilton right now. I'm kind of doing a little bit of research on the stock.
Wow, that's a good call. That knocked me over with a feather. Holy smokes.
Yeah.
I think no one's staying in those hotels. They're bleeding.
No, like you're not, because nobody's traveling, nobody's going out. So the hotel industry has dropped. And Hilton's one of the ones now that the government has started saying, if you're going to travel, we're going to start making you guys stay in one of these chains. So Hilton stock now is increased back up again.
Wow.
You're almost grabbing that nice opportunity, saying, well, the government said you come to here, so bring all the money or the revenue on my end. And of course, they may still be the one that you could see survives, all the others be like, we need a bit of help.
Could that have anything to do with these COVID jails?
You can look at it.
Okay, that's what people call them, that are where you're forced to quarantine. It's jail.
Yeah. So if we're looking at, so Hilton is one of those areas. Let's say if you're traveling, you say, oh, you of course quarantine. Of course, before it was at 14 days. I believe right now they've reduced it down a bit for travelers. Of course, so the Hilton would be one of those options, chains, as Melissa described it, where you go there, you stay there for a couple of days. Well, of course, you have to pay for it. And then, of course, you're free to travel out.
Exorbitant prices.
Well, no, see, it's right now, it's $300 a night. And you have to pay a minimum of 3 days, regardless if you use it or not. Your meals are included, and you're basically under a quarantine there. So people are saying it's better just to walk out and pay the fine than be forced to pay 3 nights at a government hotel.
Yeah,
it's cheaper to pay the fine,
especially because the fines are going to be thrown out anyway. So.
Right. So then you're in your own environment and you're controlled, and you have to still prove that you're under quarantine in your own home. And you pay your fine. So then the airport has no choice but to allow you to leave. So that's why I've been kind of looking at that chain, because it is backed right now by government. So with all personal issues aside and emotions detached, it's something to consider.
Oh, that looks amazing.
Who owns do you know who actually owns Hilton?
Isn't it Paris Hilton? The Hilton family?
Oh, I guess that would be. So, okay, fine. Yeah, you're right. Sorry. Right, yeah. I've stayed at Doubletree Hilton. Nice hotel. You know, I stayed there.
Beautiful.
This is about 3-4 years ago, I guess now. And I only was there a couple nights. I was going to be in London, and I wanted to be downtown. So, and I want a pool. That's one of the things when I travel, I like to have a pool. And so I pay a little more.
That makes a lot.
Cool.
Yeah, that makes a lot of sense. Oh, just wondering, Dave, have you been looking at the hospitality sector by chance?
I haven't found anything that I'm really in love with, though.
Okay. Yeah, that's fair. I mean, whatever floats your boat, right? It's never an instant gold mine the moment you just dig right in.
Yeah. Right now my focus is I'm basically on tech, pharma, and energy. That's where I'm really focusing right now, because even the things I'm more of a long invest. I mean, I do on the bigger money, I'm a long invest. On the shorter stuff, I throw it into the penny stuff. And the long invest right now, the hotel industry is going to pop when once everybody starts getting their shots. There's going to be people out and everything else, but then it's going to drop off again to normal levels in a year or two. I'm looking beyond that time frame.
Okay, that's fair enough for knowing. And how about Ian? Have you been doing any of that, or mainly sticking to Enbridge for the most part?
Well, listen, if we're talking about U.S. stocks, I mean, good old IBM.
Okay. So let's pull it out, see what's going on with that good old IBM. It's like, okay, they've been doing a bit of a slide downtrend, and they've been creeping back out of recently. So what's gotten you a bit of excited into IBM, or is it a good company to look at investing?
Well, it's again a dividend play there at 4.84. It was a little bit further down, I guess.
And that's
when I looked at it, like, around COVID time, but
okay. So when, let's say, COVID during May, so let's say around that 110 mark or so. So of course that will. So let's say if it was $110 with our trusty calculator, we'll do a little bit of a check-in. So if we did $110, you're paying $6.52. So $110, that's, it's almost a 6% return in US dollars.
Right.
So one of the nice little interesting, even though IBM is part of that, you could say it's still part of that, the tech side of the industry, but more on this bit of the servicing end. Because I'm looking at, yeah, it's, even though the beta side of it, it's not really that, because it's not really too volatile, even though it's above 1.
Yeah.
But yeah, because you look at the share price, just given over the past you could say from the peak in 2017, from 179, and it dropped around that 111. It takes some time to really get there, and with a little bit of bumps going up and down. So it's pretty rock solid for the most part. And of course, it just means the lower it gets, the more of a discount you can buy it at.
Right.
And just to do a little bit of a finishing off for tonight, because we did promise a little bit of a presentation, it's more of a little announcement side for you guys, is about risk management. We all know, all of you are in the stock market, and David has mentioned a bit of those before. So one of the little ideas, just as a food for thought for everyone to think of, is using a 60-40 strategy. Now, most of you will think, okay, 60%, what does that mean? So 60% as in, let's say you're in the stock market, you're buying, let's say the IBMs, for example, the penny stocks that people love to go crazy over. And you leave, let's say 40% of it in cash, as an example. Now, most of you wonder, well, why would you want to put in cash? It's not making me money, while the other 60% is making you money. We can even use, let's say IBM as a nice little example of, so let's say if you took the 60% and you did buy IBM towards the peak of the stock, let's say we'll give you a benefit that, let's say you got that at $165. It was going up, you bought 165, and you're a long-term player. You're like, okay, this thing's going to do well. I don't see it dropping. It's going to gradually go up. And then, of course, 5 years later, you go like, oh, it hasn't been doing well, and it's been creeping lower and lower. So one of the nice things when you have that bit of cash is, some of you may be familiar with, it's called dollar cost averaging. So meaning, let's say when you buy at 165, and let's say you got it at the lower end, let's say at around, I'm just gonna try to creep over and say, let's say you got it at around 120. So a little bit over from the bottom. So when you average out, if let's say you bought an equal amount for both, so we're just gonna pull this out and say, okay, if you got it at $165 and we had it at 120, so, and then we divide it equally into so this is your average cost has now been brought down. Instead of $165, you're buying it at 142 overall. Now, so you look at, well, okay, what does that mean in my return right now? So let's say right now, IBM's giving you a dividend of $6.52. So we're going to $6.52, and we're going to divide that by 142.5 for the average cost. You're looking at it's a little bit lower than the current 4.8%. It's at 4.5 US dollars. So when you add the conversion of currency, it's actually closer to 5.5 to 6%, which is pretty good. So one of the benefits is if, let's say you wanted to sell, let's say today, and you said, or you just waited till it went closer to the $142 mark, at least you're not going to have to wait till it hits all the way back to 165 just to break even if, let's say you wanted to find another suitable investment besides IBM, as an example. At least you brought the overall cost down. You don't have to wait for it to jump as high of a price from the bottom to get to the very top and basically square off your losses. And the way I'm calculating it, I'm not including the dividends as part of bringing down the overall cost. I'm just assuming that's your cash flow that you're getting every single year. And you're saying, okay, it's like different, or sorry, it's no different to a house. You bought a house, you rent it out. It's almost the same concept. The house price value may go up and down time to time, hopefully up always. And of course, your tenant's paying you a stable amount every single month. So it's similar to the concept of blue chip and dividend stocks.
Yeah, with the real estate, you also have the mortgage pay down, which is another stream, of course.
And that's, yep, you're definitely right. That's a benefit in the US, especially because they can deduct your mortgages. But in Canada, it's not the same. But as Ian mentioned with the Manulife one, way it can be done in a similar fashion, because you're essentially converting your mortgage into a line of credit. And let's say you took the line of credit out, and let's say you bought blue chip stocks that paid you a dividend. Effectively, you can say, oh, that interest rate that I'm paying to buy stocks, I can have that be paid off from these dividends. So effectively, you're almost saying you get ownership of a company and you're being subsidized to do it, because your interest rate, the bank charges you, the dividend these companies are paying, and they're hopefully you're looking for interest rate that will either square it off so you have no losses, or you get a little bit of extra as a bonus.
Well, if your number can get high enough, I mean, you can also do a drip, which is just helping your dollar cost averaging even more. So,
yeah, that's, so just for those who are trying to figure out, well, what does drip mean? So let's do our little Google search for everybody, just to see, just to get an idea what that means. Oh, that's not it. We're not talking about the stocks, but so just, let's see if this gives us a little, okay, that's not what, yep, we'll say for stocks meeting. There we go. So that's what it means. It's a dividend reinvestment plan, as Ian mentioned. And one of the nice things is some companies do have these plans built in, that so when you buy the shares of those companies with the dividend, you don't pay any of the trading fees. Normally it could be a $5 or $10 fee to buy shares at a given time. They basically cancel out the fees and they just roll it right in. You buy it whatever the price is at that moment. And on that note, because we're getting close to our little bit of our time for show, I'd first like to thank everyone for coming tonight. If you guys want to stay a bit, and of course you should, because David's got a little bit of things you can show if you guys are interested, and we'll keep the chat open for another 15-20 minutes just for everybody to discuss, have a reflection, connect with everybody, see what everybody's thoughts are. And of course, for tomorrow, we've got Tech Talk with Catherine Davies. Oh, Ivan, you're still there? Or Teresa?
Yep, I'm here.
Okay. So do you have any info of what Catherine's got going for tomorrow, or is it with Thomas?
No, Thomas was last week. So Catherine, I'm not sure her topic for tomorrow. So we'll call it a surprise. And then I believe tomorrow afternoon at 1 o'clock is Ivan's sales call. So yeah, and then Friday's Easter. Woo! Good Friday, whatever you want to call it. The beginning of Easter weekend.
Lovely.
Is there anything going on Easter Monday?
Yes, I was going to say. Yeah, Ivan and me are going to be talking about building your circles. So that's exciting, kind of like a marketing perspective. So but that will be Monday at 9:30. So come out, because it's my first time co-hosting, sorry.
Oh.
Yeah.
So.
Nice. and of course, yeah, I believe that was all for Monday. And on that note, can you give us a little hint of what's the circle you speak of?
Just like obviously we all connect business wise to each other. So so obviously as like a social media person or even just a marketing company, we have many different like strengths in that, like web design and and graphic design and like all those other bubbles. So it's about like creating the connections with the people that make your business run, basically. So not making yourself just like a one person operation, but like how you build those circles around you. Networking in a way.
Because that's definitely was giving me the idea, and the thought was almost like when you run a company, you've got all these different people in different departments. You're effectively putting those people in place to go, okay, we're all going to want to build this amazing company. Everybody's got their strengths. Let's help each other out, build this, succeed, hire more people, make Canada great, even better than America, hopefully.
But we all can't just be one person doing everything. Like we have to build connections in a way with other people in the community. And that is the whole point of this great city and our business networking. So yeah, we just have to think of the fact that we depend on other people for our businesses to survive. So yeah, should be a good discussion on Monday.
I can just see we all have to huddle together. Okay, how are we going to work as a group to get out of this?
Yeah, exactly.